inflation has moved much closer to our 2% longer run goal, our 2% objective, moving down to 2%, but get back to 2% inflation, our 2% objective. Sustainably down to 2%. Confidence that inflation is moving sustainably toward 2%.
Given how often we hear about that 2% inflation goal, you'd think it was just obvious, but it's not.
I do think to the public, there is this question, why can't the price level go back to what it was before? Why even have a 2% inflation target?
I always get questions about it, even before the pandemic, before the run-up of inflation. Why isn't it zero? Why aren't we aiming for zero instead of aiming for 2?
The question I'm asked the most on this is, did you just pluck that number out of the air?
And over the years, the Fed's 2% target has come under question from those that follow it closely.
There are risks to having inflation be too low, and the 2% target is too low. And so if we could stop this disinflation at roughly 3%, I think that would be a good compromise.
So where did that 2% inflation target come from? For that, we have to go all the way back to 1990 in New Zealand, when Don Brash was the RBNZ governor.
New Zealand had very high inflation, certainly by OECD standards anyway, double-digit inflation figures through much of the 70s and early 80s. And the then Labour government decided that they were going to get inflation right down. In 1988, the Minister of Finance asked about inflation dropping below 10% for the first time in some years. Said, well, aren't you satisfied now? And the minister said, no, I'm looking for zero inflation, or maybe 0 to 1%. Over the next couple of years, that was modified gradually. So the target became 0 to 2% by 1992. And that was the target that I signed up to. Subsequently, of course, the target was slightly amended, and we went to a target at midpoint of 2%. We could explain to people what we were targeting. People understood the game. And in the early years, particularly of my time as governor, I spent a huge amount of time talking to farmers groups, Rotary clubs, church groups, any groups that would listen, making it very clear that we were deadly serious about achieving that target.
And from there, it went worldwide.
Inflation returns to our 2% medium-term target.
Inflation is now back to the 2% target.
Inflation has been close to our 2% target.
Canada followed suit, then the UK and others. And in early 2012, the US adopted the 2% target.
The committee judges that inflation at the rate of 2% is most consistent over the longer run with our statutory mandate. Clearly communicating to the public this 2% goal for inflation over the longer run should help foster price stability and moderate long-term interest rates, and will enhance the committee's ability to promote maximum employment in the face of significant economic disturbances.
John Williams, now the New York Fed president, was in charge of the San Francisco Fed when the policy was adopted. He recalls that the motivation was transparency.
When Chair Bernanke came to the Fed, clearly he had strong desire for us to continue the work on transparency, be clear about our objectives, which actually had started under Chairman Greenspan and a lot of movement toward transparency then. So going back to January of 2012 and the discussions that led to that, I had just joined the FOMC in the spring of 2011, so I was there for that. And it was really a focus on greater transparency, greater clarity about what does good look like. We don't want inflation that's too low. We don't want inflation that's too high. And importantly, what's the inflation rate that's consistent with the dual mandate that the Fed has, which is relatively unique to the Fed.
Good afternoon.
But the urge to have a clear, transparent inflation goal didn't mean that the goal necessarily had to be the 2% one that other countries had adopted.
With 19 participants, or however many were in the room at the time, there's always a wide range of views. So if you were to ask the question, is 1.5% or 2 or 2.5%, are those right or wrong answers? I think any of those answers would work. I think 2% is a good, kind of Goldilocks answer.
Given what other central banks had already done by 2012, Chair Bernanke's announcement was hardly a shock. But it did spark plenty of debate. And one of the voices initially against the target was the current Chicago Fed President, Austin Goolsbee.
I wasn't in the Fed at that time. I was actually kind of publicly critical that 2.0% conveys a false sense of precision. That inflation's a noisy series. And just telling the difference, if I told you how many months of inflation data would it take, given the variability of the series, to tell the difference between a 2.0% inflation rate and a 2.2% inflation rate? And the answer is years, if not decades, of data before you would be able to even tell the difference. So that's why I was kind of critical at the time. But that said, I've completely changed my view, and I'm now a strong advocate.
Whatever the pluses and minuses of the Fed's 2% target were when it was adopted over a decade ago, it's now well established, and the markets have come to depend on it.
The Fed has a 2% inflation target on average. How does that affect the markets?
It's extremely important. So I'll start with that because, and having that credibility that it is 2% over time, because what we do is the market is essentially pricing in an expectation and a risk around the expectation over time.
Priya Misra is a portfolio manager at JP Morgan.
So now if my inflation is somewhat understood, then I'm pricing real rates over it. And so I'm talking about the Treasury curve. It contains that Treasury curve, the inflation part, then we have to just price in where are real rates. So I think it helps anchor expectation. It also tells us how should the market price in the Fed response to, either another policy shock, fiscal policy, or a shock to the economy.
For someone dealing daily in the markets like Misra, the fact of simply having a clear target is more important than exactly what that target is.
Somewhere in the 2 to 3% range is fair. Now, the Fed in 2012 picked 2%. It's somewhat arbitrary. You could have picked 2.5%, but they picked 2. I think it's a fair number. It allows the Fed, if you think the Fed doesn't want to go to negative rates, and look at Europe and Japan, it's not clear the negative rates were that effective. In fact, they have all these negative externalities. It allows, if inflation is at 2, it allows real rates to go negative, because if Fed funds gets to 0, that's a negative 2% real rate, which is very stimulative for the economy. So I think somewhere in that 2 to 3% range is important.
As much as the markets rely on that fixed 2% target, does it matter that the Fed doesn't hit it all that often? Since Chair Bernanke announced the target in 2012, it's been within 0.2% of target in only 20 of 155 monthly readings. And in more recent times, inflation has been stubbornly stuck above the target. After peaking in 2022, the core PCE, that's the Fed's preferred inflation gauge, showed signs of progress when it fell to 3% in 2023. But since then, it's largely flatlined, leaving some to speculate about possible upward risks to inflation, given an economy that appears to be running hotter than anticipated, perhaps because of structural changes.
The only reason we talk about the inflation risk is because we compare it to an arbitrary target that I'm willing to bet if we were to set today, we would not set at 2%. We'd set at 2.5 to 3.
But suggest changing the inflation target at this point to those in the markets, and you get a strong reaction.
The Fed has said we're not looking at the 2% target right now. Let's assume a counterfactual. What if the Fed tomorrow came out and said it's not 2%, it's 2.5%, maybe even 3%? How would the markets react?
My blood pressure is increasing just as you say it, because it's a Pandora's box, right? You start with, it's just a 50 basis point increase. It's a slippery slope. A year later, well, maybe it's another 50 basis point. Once you open the door to any increase in the inflation target, I think the market has to price in the risk that could continue to rise. Given where inflation is right now, above target, I think it's disingenuous for the Fed to raise that target. It's like me trying to run a marathon, and then when I realize it's really hard to run that much, I just lower my target to a 10K. Not that I can run a lot, but it just doesn't sound credible.
We said the target is 2%. And once you set a target, that is a sacred promise that the central bank has made. And you can't debate coming up with a new target just because you're not hitting the old target. You got to finish your job before you start looking for a new job.
I would say on inflation, it all comes down to expectations. So why do I think we should take the inflation target for granted? Is because expectations, it would be great if inflation expectations are well anchored. Because then if I'm a business, I can plan for pricing, I can plan for my investments over time, because I know this is where inflation, roughly speaking, on average will be over time. If I'm a household, I can have that same expectation. If I'm an employee and I'm going to ask my employer for a raise, again, I have a sense of where that is.
But for all the benefits of setting expectations for overall inflation with a simple, single goal of 2%, it doesn't mean that everyone will experience the same level of inflation across all socioeconomic groups, industries, or geographic areas. And after a sharp ramping up of inflation, those expectations don't return us to the prices we knew only 3 years ago. So that is where we turn next. How people are affected by inflation that hits us all differently.
People feel the higher prices. I feel the higher prices. And when I go and explain, well, inflation is coming down, of course, they don't see that because they go to the grocery store, as I do, and prices are still high. I do the grocery shopping for my family. I still have sticker shock. I haven't adjusted in my expectations about what normal is when I go to the grocery store.